Okay, so the topic today would be receivable financing. Basically, this deals with the accounting treatment for the different transactions or options available to companies in coming up with funds or financing by using its receivables. So basically, a company who is in need of funds would use its assets, particularly in this case, will use its receivables in order to be able to borrow or get money from other parties, get money from fund providers. Okay, and as you can see here, the three ways or modes of using our receivables as a source of financing that will be discussed today would be your pledging, assignment, and factoring. Pledging an assignment is basically uh, using your receivables as a collateral in exchange for the funds that you would be borrowing. So the basic premise here is that you will borrow money from a third party fund provider, and to entice that entity to borrow or lend you money, you would use your receivables as a collateral, as a form of security. Primary difference here is that for pledging, uh, you do not specify as to what particular receivables will be used. You are just using all your receivables in general. Whereas in your assignment, a the receivables that would be used as a collateral would be specified, and it to the point that some depending on the arrangement, actual collection of the receivables being used as a collateral, actual collection of receivables that are assigned to the third party, to the other entity, to the capital provider or the fund provider, it will be done by the lender already. The one who extends us a loan will be the one to make the collection. That is if the assignment is on a notification basis. Okay, but basically the point here is that pledging and assignment are similar in a way that the two of them works under the same arrangement wherein our receivables are going to be used as a collateral or a security. Okay. The third form of receivable financing that will be discussed will be your factoring, which is essentially a sale of your uh, receivable. Okay, so it's different from pledging and assignment, uh, since in pledging and assignment you borrow money and you use your receivable as a collateral, whereas in factoring you are actually selling the receivables, you are letting go of the receivables, and you are able to use your receivables as a source of fund because you are selling it in exchange for funds or in exchange for cash. Okay. Uh, and that is why, as a point of comparison among these three, in factoring, you will be removing from your records, you will be recognizing the receivables that are being factored. Whereas in pledging and in assignment, since you are just using them as a collateral, the receivables that are being pledged or assigned will still remain in our records. Okay, so for both pledging and assignment, the receivable will not be recognized. Okay, however, for assignment, the receivable that is specifically designated or specifically assigned to the fund provider will be reclassified. Okay. Our total receivables will be the same, just like in pledging. Your total receivables will not go down. In assignment, total receivables will also not go down. However, the receivables that are assigned will have to be reclassified. So we will be using another account to represent all our receivables that are being assigned. If you've gone over the textbook, the account title that is used would be your accounts receivable assigned. Okay, so from your uh, accounts receivable, you will reclassify or transfer it to accounts receivable assigned. Okay, but in your financial statements, they will all be lumped together as part of your receivables. Okay, we use a separate account simply for monitoring, for the purpose of having a separate ledger for all receivables that are being assigned. Okay. As you can see here, assignment may be on a non-notification or notification basis. Notification meaning we are notifying the customer that owes us money. Okay, so if it's a notification basis, the person, the customer who is supposed to be paying us for the goods we have sold or for the services we have provided will be notified that his account is being assigned to another entity. And in this case, normally it would now be the fund provider that will make the collection. By virtue of the notice given, the our customer can pay directly to the fund provider. On a non-notification basis, the customer is not made aware of the assignment. As far as the customer is concerned, it's as if nothing changed. Okay, but between the entity and the fund provider, the moment the customer whose account was assigned makes a payment, the duty of the entity is to forward the payment to the fund provider as a payment of our borrowings. Okay, remember that in an assignment, we are basically borrowing money and using our receivable as assigning our receivable as a form of a collateral. So under notification basis, collection may be done directly by the fund provider. The customer can pay directly to the fund provider. On a non-notification basis, the customer is not made aware of the assignment. So, of course, it will follow that the customer will pay to the entity. Okay, and it is now the duty of the entity to forward or to remit the payments of the account uh, of the customers, the payments of the customers whose accounts were assigned to the fund provider. Okay, so for both pledging and assignment, definitely there is no transfer of ownership of the over the receivables. It remains with the entity. So if ever you will be asked compute for the total receivables, then the receivables that were pledged or the receivables that were assigned should still form part of your total receivables. Okay. Unlike in factoring, then the receivables that were factored or sold will no longer be part of our total receivables. Okay, because there will be transfer of ownership, and we will have to recognize the related receivable. Okay. Uh, for factoring, the arrangement can also come in two ways. The factoring may be with or without recourse. With recourse, meaning the fund provider, the one who purchased or paid our who bought our receivables, may come after us in the event that the receivables will not be collectible. Okay, so if you will ask why would someone want to buy our receivables, okay, because they will be buying it for a price that is normally lesser than the amount of the receivable. So for example, if our receivables is 3 million, then definitely when we sell it, it will be at a lesser price. Okay. And since normally the factor will be the one to shoulder the risk of non-collection, and that is why they will most likely, and that is why they would only agree to buy our receivables at a discounted price. So the motivation, the incentive on the part of the factor here would be that they are buying an asset at a lesser price, and they will be able to profit from it if they will be able to collect. They will be able to collect an amount greater than what they have paid for it. So very basic. If they acquired a receivable for 2 million, and then they only pay for 1,500,000, and they were able to collect the entire 2 million, then the extra 500,000 they were able to get would be a profit on their part. So that is their incentive. That is the reason why some entities would engage in such business. And as I mentioned earlier, the factoring arrangement may be either with or without recourse. Okay. Uh, Meaning, if there are portions that are not collected, if it is with recourse, then the factor can run after the entity who sold the receivable. Okay, so it's as if the entity still has a subsidiary liability. In case it is not collectible, in case the factor cannot collect, then the entity will have to pay for it. If it is without recourse, then all the risk of non-collection is transferred or is shouldered by the factor. And if you'll ask, why would anyone do that? Okay, uh, some entities will decide uh, to buy the receivables without recourse, but of course only for a significant discount in the value of the receivables. So if the receivables was 2 million, and if it is without recourse, then uh, they can decide to pay for it at a very low price if it is without recourse. Okay, the higher the risk, then the higher the reward. If the factor will shoulder most of the risk, then they can demand to pay for a lower price. So it's a matter of pricing. Okay. Uh, Going back to factoring with recourse, it's not a big problem for us to it's not a big problem for us to enter into such arrangement. Okay, especially if it will allow us to get more out of our receivables. For example, the 2 million receivables, if it is with recourse, what if the entity will allow us will what if the factor will pay 1,900,000 because it is with recourse? Okay, the discount or the amount that is uh, considered as a discount is only 100,000, which is only to facilitate the early conversion of our receivable into cash. Okay, but if it is without recourse, then the factor can say that he or she is only willing to pay 1,500,000, 1,600,000. But for factoring with recourse, uh, we can expect for a higher recovery or higher conversion of our receivable. Okay, and uh, what if, for example, 300,000 was not collected by the factor? What will happen? The factor will pay for it, but that is not a big problem because the entity who sold the receivable can still get the 300,000 receivable that was not collected. Okay, if the customer did not pay, if the customer did not voluntarily pay, then the entity can simply run after that customer, file the necessary case for the collection of sums of money. Okay, so just because it was not paid when it became due doesn't mean that all is lost. Okay, so that's why it's not a big problem if the factoring arrangement is with recourse. One benefit on the part of the entity selling the receivable is that the amount of money that they will be able to get from the receivables can be higher compared to when the arrangement is without recourse. Can we are not worried if the customer will not pay the factor, because even if we will have to pay the factor later on, we can still run after our customer. Okay, but of course the burden or the hassle is now with us. But again, we are willing to go through that because of the chance of getting more out of our receivables. Okay, I hope you understand that, of course, uh, the amount that we'll be able to get from our receivables under a with recourse arrangement would be higher compared to a factoring without recourse. Okay. As far as accounting is concerned, if the factoring is with recourse, then we will have to recognize a contingent liability, we will have to recognize a recourse liability, which will be uh, recognized at the time of factoring. Okay? It is a liability that can happen in the event that our customer will not pay. And the effect of a recourse liability is that it will increase the loss on factoring. Okay. So for this, for factoring, it's possible that no, it's likely that we will have to recognize a loss on factoring because obviously we are getting lesser cash than uh, than the amount of receivables that we actually have. The receivable is 2 million, and we are only getting cash of 1,500,000. Then, uh, if that's all the if that's all there is to it, then we can say that we lost 500,000. Then you would ask, why would we enter into such arrangement? Why would we willingly decide to get only 1,500,000 when our receivables is actually worth 2 million? Why would we willingly decide to lose 500,000? Okay. Remember that in your accounts receivable is still receivable. As of today, it does not represent cash. So what if we have is an urgent need for money and we cannot wait anymore for the day that the receivable becomes due and collectible. Okay. So what if the loss that we will suffer today for not having cash is greater than the loss that we are incurring as a result of the factoring? So those are the things that the entity will have to consider. Okay, but it's it's uh, it's common for us to convert our assets at a lower price so long as they are converted into cash. If you have heard of the saying, a dollar today is worth more than a dollar tomorrow. So the 2 million 30 days from now may not be uh, as valuable than 1,500,000 or 1,900,000 today. Okay, it depends on the urgency or the importance of having the cash now. Okay, so if you really need 1,500,000 now, otherwise you will be asked to pay a penalty of more than 500,000, then definitely it's worth it to uh, sell our 2 million receivables for 1,500,000 only. Okay, the scenario I am contemplating is that we have a we have a loan that becomes due. We have a loan whose installment becomes due today, and if we will not be able to pay the installment, we may be either forced to pay a penalty or the entire obligation may become due, which we do not want. So in that case, it might be better for us to sell off our receivables at a lesser price. Okay, so that's the reason behind why we would willingly convert our receivables in an amount that is significantly lower. Okay, and so basically that's the concept behind these three kinds of receivable financing. We are using our receivables in order for us to get cash immediately. Under pledging and assignment, they are just only used as a collateral to entice fund providers to extend a loan to us. For factoring, we are actually selling the receivables already to in order for us to have cash immediately. Okay, and let's just go over the uh, let's just go over the multiple choice problems in chapter 8 of the textbook. Okay, so let's start with the first multiple choice problem. Basically, in problem 8-13, we assigned 4 million of our receivables as a collateral to a 3 million borrowing from a bank. Okay, and the arrangement is that we will have to pay interest on the interest on the promissory note, interest on our borrowings at an amount of 5%, of course, based on the uh, amount of borrowings to be deducted in advance. So meaning, even though we are borrowing 3 million, even though our liability will be 3 million, the amount that we will actually get would be uh, lesser than 3 million. And if you read question number one, what amount of cash was received from the assignment of accounts receivable? Uh, uh, you should take note that this would be the most common question for most receivable financing problems, because after all, the reason that we engage in receivable financing transaction is for us to get money immediately, okay, to get money out of our receivables as soon as possible. So you can expect that the most common question here would be, uh, how much cash are we getting from the receivable financing transaction that we are engaging in? Okay. By the way, this is an example of an assignment problem, and you'll also notice that you will encounter very few problems involving pledging, because again, it's very similar to assignment. And on the part of the transaction wherein we will be borrowing money, the accounting there is similar under assignment, and similar also to the basic notes payable transaction that we will also be discussing later on. Okay, for pledging problems, it would almost always involve a different kind of receivable financing transaction. Okay, because the main issue involving pledging is whether or not the student knows that pledging will not have any effect on total receivables. So what I'm saying is that for problems involving pledging, the common question there would most definitely be how much would be your total receivables. And the concept that is being tested on the part of the students is whether or not you know that pledging will not affect your total receivables. Okay, it will not even result in any entry as far as the receivable is concerned. Okay, although there will be a disclosure in the notes of the financial statements, but as far as your balance sheet or your income statement is concerned, pledging will not have any effect. Okay. Now, the main issue here is always how much cash are we getting from this transaction. Okay, and we already know that we will have to pay a finance charge of 5%, and that the finance charge will be deducted in advance. Okay, the question now is, what would be the basis of the 5%? Okay, again, it should be based on the amount that we are borrowing. So since we are only borrowing 3 million, uh, the finance charge that we will be paying would be 5% of the 3 million. And 5% of 3 million would be 150,000. And that is the amount that we will deduct from the amount that we are supposedly borrowing. And the question now is, how much are we borrowing? Is it the 4 million or the 3 million? Uh, we are only borrowing 3 million. And of course, that is the amount that we are supposedly getting from the bank. So without the finance charges, we are expecting to get 3 million from the bank. But because of the finance charge of 150,000, we will only be getting 2,850,000. And that would be the answer here. And it's not among the choices. Okay, there's seem to be an error here, but our answer should be 2,850,000. Okay, if this comes out in our exam, remember that the correct answer here is 2,850,000. Okay, you can expect that the amount of receivable that is being used as a collateral would almost always be greater than the amount that we are borrowing, would be greater than the amount that we are getting. Okay, so possible sources of error here for the students would be that they would think that we are getting 4 million. That's wrong. We are only borrowing 3 million. Others would also think that the 5% would be based on the 4 million. Okay, again, that's wrong. The 5% should be based on the amount that we are borrowing. Since we are borrowing 3 million, but we are paying in advance 5% finance charge amounting to 150,000, determined by multiplying 5% and 3 million. the amount of cash that we would be getting would be 2,850,000. Okay, and that's actually what happens in practice. The collateral, the value of the collateral be greater than the would be greater than the amount that will be extended as a loan. So the answer here is 2,850,000. So again, if this comes out, the answer should be 2,850,000. Next question: what is the carrying amount of the note payable on December 31, 2022? Okay, uh, on December 1, the date of the borrowing class, our note payable will begin at 3 million. Okay. Then we are asked on December 31, how much will be its carrying amount? So do we expect the carrying amount of the note payable to change after a lapse of 1 million in this problem? The answer is yes, because between December 1 and the end of the year, there were transactions that happened that would affect the note payable. And what transaction would that be? We have the collection of the assigned accounts receivable. Okay. Uh, uh, Remember that in assignment, the amount that we will be getting from the receivables that were assigned would be remitted to the lender, to the one who provided us with money as a payment of our borrowing. So here we were actually able to collect 2 million worth of receivable. Okay. So the question now is, does that mean we were able to pay the bank 2 million by this day? Uh, The answer is no, because the 2 million here represents the value of the receivables that were collected. Okay, but is that actually the amount of money that we were able to get? The answer is no. We were only able to get 1,900,000. And where did we get 1,900,000? Okay, uh, because out of the receivable, the 2 million receivables, we were only able to get 1,900,000 because the customers were able to avail of cash discount amounting to 100,000. Okay, the value of the receivables that were paid off was 2 million, but the actual amount of money that we were able to collect is only 1,900,000, owing to the 100,000 cash discount. Okay, so uh, please understand that the amount of receivables that are being collected may not be the same as the amount of cash that we were able to get. So in this case, we were able to get 1,900,000. And what are we supposed to do with the 1,900,000? Uh, we would be remitting this to the bank. We will be giving this to the bank as a payment of our borrowings. Okay, but will that mean our answer is 1,100,000 since we borrowed 3 million and then we were giving 1,900,000 to the bank? Will our answer be 1,100,000? Here the answer is no. Okay, but first question: did we actually give the entire 1,900,000 to the bank? The answer is yes. Okay, but so if we actually gave the entire 1,900,000 to the bank, why will our liability to the bank not be decreased by 1,900,000? Because understand that the 3 million there represents the principal of our liability. Okay, and the 1,900,000 that we are paying will be applied first to the amount of interest that has already accrued. Okay, if you can recall in your obligations and contracts, if payments are made, payments are to be applied first to the interest before the principal. And from December 1 to December 31, there is already interest that has accrued. Interest equivalent for 1 month. Okay. And if and this is where the 12% stated rate on the note comes into play. Since the note has a stated interest of 12%, that means per month it will earn 1% interest. And how much is 1% of 3 million? That's 30,000. So that means for the month of uh, December, we owe the bank interest amounting to 30,000. So the 1,900,000 that we are giving to the bank will be applied first to the interest, to the 30,000 interest that has already accrued. Okay, that has already become due. Okay, so uh, Out of the 1,900,000, 30,000 goes to the interest, to the payment of interest. So that means the amount that will be applied to the principal will only be 1,870,000. And 1,870,000 deducted from 3 million will give you 1,130,000, and that will be the balance of your notes payable at the end of the year. Okay, so please do not forget to apply first your payment to the interest that has accrued. Third question here, which is another common question involving assignment class, uh, since this would be one of the disclosures that will be required. Uh, Basically, the question here is how much is the equity in the assigned accounts. Okay, so what's the logic here? Just go back to your accounting equation. Accounting equation is assets is equal to liabilities plus equity. Okay, so we have our receivables, but we have assigned this as a result of a borrowing. So that means part of our receivable is funded by a borrowing. So basically, if you're looking for your equity in your receivables, just deduct the liabilities from your assets. Okay, but the assets and liabilities I am talking about here would be the receivable and the notes payable. Okay, so if assets is equal to liabilities plus equity, then equity then is equal to assets minus liabilities. And that's how you are going to solve for the equity. Okay, you determine your assets and then uh, deduct the remaining liability, and that will give you your equity. Okay, we already have the equity. We already have the balance of our liability, the balance of our notes payable as computed in number two, which was 1,130,000. Okay, the only thing we need now would be the balance of our assets, the balance of our receivables. Uh, uh, Common error on the part of the students here would be to think that the the amount that we'll be using here would be the 4 million, but remember that there were collections already during the year. On December 31, the receivables were still at 4 million, but between December 1 and December 31, there were already collections. Okay, so we began at 4 million, but we were able to collect 2 million worth of receivables. So based on the collections alone, the balance of our receivables would only be 2 million. But if you go further in the problem, it tells us that there were actually sales returns. Okay, if you can recall, what's the effect of sales returns to your accounts receivable? It will decrease because every time you receive sales returns, your entry will be debit sales returns and credit accounts receivable. Okay, and the 150,000 returns here pertains to the assigned accounts receivable. Okay, so that would be considered in our computation. And there were also write-offs amounting to 200,000. So the entry for the write-offs would be debit allowance for doubtful accounts and credit accounts receivable. So our accounts receivable would again be affected. So out from 4 million, it was reduced to 2 million because of the collections. Okay, and it is further reduced by 150,000 and 200,000. So receivable, the remaining assigned receivable would be 1,650,000. So that would be our asset in our accounting equation. Then deduct the balance of your notes payable, which will serve as our liability in our accounting equation. Assets minus liability will give us equity. So assets of 1,650 less less liabilities of 1,130, the equity in the receivables would be 520,000. So the answer here would be 520,000. Okay, so this might come out in your exam. I may just change the amount of sales returns or amount of write-offs. Okay, and I'll be asking you these three questions. Okay. Now, why do we bother determining the amount of equity in the assigned receivables? So, because again, as I mentioned earlier, this would be disclosed in the financial statements. Okay, and why do we need to disclose this one? so as to inform the financial statement users that the assets that are reported by the entity may not actually be uh, available for use in the operations or even for distributions or payment of creditors. Okay, it's possible that without making this disclosure, the financial statement users might be misled into believing that the entity is very liquid. Okay, because accounts receivable is a current asset. Okay, if we have a lot of accounts receivable without knowing that these were actually assigned as a collateral to our borrowings, then financial statement users might think that the entity is actually very liquid, when in fact uh, the entity has no more control over the cash that might be collected out of these receivables, because they will just be remitted to our creditors uh, from this borrowing. Okay, so that's why there's a need to make this disclosure. Let's proceed to problem 8-14. Uh, Brony Company factored 8 million of accounts receivable to a finance entity at the beginning of the current year. Control was surrendered by Brony. The factor assessed a fee of 5% and retained a holdback equal to 10% of the accounts receivable. In addition, the factor charged 15% interest computed on a weighted average time to maturity of the accounts receivable. Okay, so this is factoring. So we are actually letting go of the receivables. As I mentioned earlier, the most common question would be how much uh, cash are we getting from this transaction? Okay, so in some sense, we will have to get the selling price. Okay, how much is the proceeds from the sale of this 8 million worth of accounts receivable? Okay, uh, so basically, the problem is telling us that we are paying the factor 5%. Okay, so basically that will serve as the profit of the factor. So you get 5% of 8 million, you would get 400,000. Okay, and then that would be taken from the supposed 8 million value of our receivables. Okay, if only we could convert our 8 million receivable into cash without any loss, then we should be getting 8 million. But of course, for accommodating our financing needs, the factor is assessing as a fee of 5%. And all in all, that would be 400,000. And aside from that, uh, the factor will also be retaining an amount amounting to 10% to serve as a holdback. Okay. You can think of this as a deposit. Okay, this would be deducted from our 8 million. Okay, but if the 8 million can be collected, will eventually be collected in total, then later on the factor will just return to us the 10% that is being held back. Okay, so the holdback will not necessarily be part of our loss. Okay, it will only become part of your loss if uh, there are portions that are not collected. But if all our receivables are collected, then the holdback will not be considered as part of our loss. Okay, but as to the question of how much we are receiving, definitely the holdback will reduce the amount that we'll be getting. Okay, so just to clarify, a holdback is not necessarily an expense or a loss on our part, provided that the factor will be able to collect on the entirety of the receivables. It will only become a loss on our part if the factor will not return the deposit or the holdback to us. And the only reason that the factor will not return our deposit or the holdback is if the factor is not able to make a full collection. Okay. But if we are talking about the amount that we are getting from the transaction, then of course, since the factor is holding it back, since the factor is uh, holding back this amount, then definitely it will reduce the amount that we are getting from our receivables. So all in all, based on these two items, the factor will be taking 15% from the 8 million, 5% as a charge, and 10% as a holdback. Which again, the 10% again can be recovered later on, provided there is full collection. In addition, the factor charged 15% interest computed in a weighted average time to maturity of the accounts receivable of 30 days. Okay, so aside from the 5% factors fee, uh, as a form of discounting the value of our receivables, a, an interest charge is also being deducted from our receivables. Okay, and basically you just have to compute. You get 15% of your 8 million. Okay, but of course that 15% is if it was outstanding for one whole year. But as mentioned here, the weighted average time to maturity for our receivables, meaning the amount of time from now to the due date of our receivables, the date as to when they can be collected is 30 days on average. Okay. So of course the interest that should be charged should be commensurate only for 30 days. Okay. So after multiplying 15%, you multiply it by 30 and divide it by 365. And this is one important theory you'll have to remember, class. If the problem gives you a weighted average time uh, for our receivables, then your denominator should be 365. If it does not use the weighted average, then just use 360. You just use simple interest computation of 360. Yeah, I hope you will be able to remember that one. So to get the interest charge here, multiply 15% with 8 million and then multiply it with our uh, fraction of 30 days over 365 days. Okay, I don't have a calculator right now, but all in all, uh, after deducting 400,000 uh, factors fee and 10% 10% holdback and plus the 30-day interest, the net cash proceeds in this problem would be 6,701,000 and 370. Okay, so again, 8 million minus 5% minus 10%, or 8 million minus 400,000 minus 800,000 minus the interest for 30 days, uh, you would get 6,701,370. Next, assuming all accounts receivable are collected, what is the loss on factoring? So in this case, the components of our loss would simply be the factors fee, and the interest. Okay, and in this case, it would be 498,000 and 630. Okay, so it will just be the factor fee of 400, and this means that the interest then was 98,000. 630. Okay, so again, remember that the holdback will not be a component of your loss provided that there is full collection. Because if there is full collection, you will be able to recover the amount that is being held back by the factor. Next problem, Canin Company factored with recourse 2 million of accounts receivable with the bank. The finance charge is 5% and 10% was retained to cover sales discount, sales returns, and sales allowances. The transaction met the condition to be considered as a sale but subject to recourse for non-payment. The factor estimated the fair value of the recourse obligation 50,000. Now, again, I mentioned this earlier. If the factoring is with recourse, then you will have to recognize a contingent liability, your recourse liability, and the consequence of having to recognize a recourse liability is uh, it will result in it will increase your loss on factoring. Okay, but if later on uh, the liability will not materialize, if there is nothing to pay, uh, if we do not have to pay for the recourse liability because there is full collection, then the loss will simply be reversed. But as far as the accounting for the transaction, the date of the transaction itself, we will have to recognize a recourse liability, and the recourse liability will uh, be a component to our loss on factoring. Okay, so uh, we have a finance charge of 5%. So 5% of 2 million would be uh, 100,000, and then recourse liability of 50,000. Uh, our total loss on factoring would be 150,000. Okay, again, do we include in our loss, or do we include in our loss on factoring the amount of holdback? The answer is no, because again, uh, uh, we can still recover the holdback after the end of the transaction. Okay, so the answer here would be again Charlie 150,000. If you are asked how much cash is received in this transaction, our answer would be mm, our answer would be 1,700,000. 2 million minus 100,000 finance charge minus 200,000 factors holdback. So total deduction would be 300,000. So the amount we will be initially receiving would be 1,700,000. The recourse liability will not affect our cash proceeds. Okay, please remember the recourse liability will not have an effect on our cash proceeds on the date of the transaction. 8-16, Cynthia Company factored 750,000 of accounts receivable at year end. Control was rendered. The factor accepted the accounts receivable subject to recourse for non-payment, and the fair value of the recourse obligation is 20,000. The factor assessed a fee of 2% and retained a holdback equal to 4% of the accounts receivable. In addition, the factor charged 12% interest computed on a weighted average time uh, to maturity of 51 days. Okay, so uh, I'll try to use my cell phone to solve for the interest so that we can solve it together. First question here, how much cash is received? So we factored 750, but what are the deductions? First deduction would be the factor's fee of 2%, and then we have a holdback of 4%. So all in all, that's 6% deduction from our proceeds. So 6% times 750, that will give us 45. But aside from the 45, we'll also have to we'll also have to uh, the fund provider is also charging us with interest. Okay, so 750 times the rate of interest of 12%, but only for 51 days, since that is the average number of days our receivables will remain outstanding, divided by 365. 365 because what is being used is the weighted average. So we will get 12,575 and some change, plus the 45,000 we have computed earlier, then deduct this from 750. This would give us 692,425, and that will be our answer. So the deductions here are the factors fee, the holdback, and the interest. Okay. Next, what amount should be recognized initially as loss on factoring? Okay. From the problem, our loss will have three components. Number one, the factors fee. Number two, the interest charge. And number three, the recourse obligation. Again, remember that the holdback will not be considered as a component of our loss on factoring. Okay. Especially the question is how much should be recognized initially as loss on factoring. There will only be a there will only be the holdback will only be considered as a loss once we cannot recover it anymore. Okay. So as computed earlier, our Uh, our interest was, I forgot to put. Let's do it again. 750 times 12% times 51 divided by 365. So the interest charge is 12,575. And then the recourse obligation is 20. Again, remember that the recourse obligation will form part of our loss and factoring. And then you get the factor's fee of 2%. That would give us 15,000. 2% of 750,000 is 15,000. This would give us 47,575. Okay. So the problems are very straightforward, class. Uh, Point of confusion here for students would be, as I have repeatedly mentioned, class, would be the inclusion of the holdback. Some students would think that the some students would think that the holdback will form part of the loss. The answer is no. Okay. Some other students would arrive at the wrong conclusion that the loss can be computed as the value of the receivables minus the cash proceeds. Okay, although that may be correct in some problems, but that's conceptually incorrect. Okay, because uh, the recourse obligation does not affect your cash proceeds, and then the holdback affects your cash proceeds, but it's not a component of your loss on factoring. Okay. Just remember the common components of your loss on factoring would be the factor's fee, the interest charges, and the recourse obligation. And remember that you will only have the recourse obligation if the factoring is with recourse. 8-17, the EC company sold accounts receivable without recourse with face amount of 6 million. The factor charged 15% commission on all accounts receivable factored and withheld 10% of the accounts factored as protection against customer returns and other uh, adjustments. The entity had previously established an allowance for doubtful accounts of 200,000 for these accounts. By year end, the entity had collected the factor's holdback, there being no customer returns and other adjustments. What amount of cash was initially received from factoring? If you'll notice, kasi the amount charged with the factor here is significantly higher than the problems we had encountered earlier, because here this is without recourse. The factor will be the one to shoulder all the uh, worthless receivables. Okay. First deduction here would be the factor's fee or the factor's commission of 15%, and 15% of 6 million would be 900,000. Okay. Next, the holdback here would be 10%, and 10% of uh, 6 million would be 600,000. Okay, so 600,000 plus 900,000. The total deduction here would be 1,500,000, and that is why the amount that we will initially receive would be 4,500,000. What amount should be recognized as loss on factoring? Our answer here would be uh, the 15% commission and all accounts receivable. Uh, the the factors holdback here, class, is sorry, the factors fee is 900,000. Okay, but it's not, our loss would be mitigated by the amount of allowance that we have already established, amounting to 200,000. So that is why the loss on factoring here should only be 700,000. Okay. Another way of arriving at 700,000 would be getting the carrying amount of the receivables. Okay. If you can recall my illustration earlier, if you have receivable of 2 million, you were able to sell it for 1,500,000, then you will have a loss of 500,000. You can also solve it. You can also solve it uh, that way. Even though the receivable was has a face amount of 6 million, but we have already established an allowance of 200,000. The carrying amount, the book value of this receivable is only 5 million. 5 million. 800. Okay, and then uh, we were able to get how the proceeds we were able to get amounted to 4 million 500. So 5,800,000 minus 4,500,000 will give you 1,300,000. Okay, but uh, the amount deducted in getting at our cash proceeds included a holdback that we can still recover. Uh, Actually, we were able to fully recover, as stated in the last paragraph of the problem, uh, amounting to 600,000, which is 10% of 6 million. So 1,300,000 minus 600,000. Our loss would be 700,000, or simply just use the 900 minus 200. 8-18, Zeus Company factored 6 million of accounts receivable to a finance entity at the beginning of current year. Control was surrendered by Zeus. The factor accepted the accounts receivable subject to recourse for non-payment. The fair value of the recourse obligation is 100,000. What's the significance of this recourse obligation? This will uh, increase our loss on factoring because this is a component of our loss on factoring. The factor assessed a fee of 3% and retained a holdback equal to 5% of the accounts receivable. The factor charged 15% interest computed in a weighted average time to maturity of 54 days. What amount of cash was initially received from the factoring? So what are the possible deductions here? The factor's fee, the holdback, and the interest charge. Okay, so factor's fee and the holdback is a combined 8%. 8% times 6 million, that will give us 480. And then the interest charge here is 6 million times 15% times 54 divided by 365. That means the interest charge is 133 and 133,000 and 133,150 pesos plus the uh, 480,000. Total deductions would be 613,000. Deduct this from 6 million, we would get 5,000,000 386,850. Okay, so that will be answer here. If all accounts are collected, what amount should be recognized as loss on factoring? The accounts receivable. First component would be the factor's fee of 3%, 6 million times 3%. That would give us 180. And then next will be the interest charge. I forgot how much the interest charge was. It's 133, 150. Next would be the recourse liability. And the fair value of the recourse liability is 100,000. Okay. But the scenario here is if all accounts are collected, what amount should be recognized as loss? Our answer here would only be 313,150. Uh, we will not include the recourse liability of 100,000. Okay, since all the accounts were collected. As I've mentioned, the recourse liability and the loss on recourse liability will just be set off against one another in case there is full collection. Okay, but question, how is this different from the problems we have solved earlier? In the other problems, the question was how much was the initial loss on factoring. Okay, so if the question was initial, then we will include the loss on factoring. We will include the recourse liability. But here we are already told that the all the accounts were collected, so that means we will not the recourse liability will not materialize. So we'll reverse the previous 100,000 component of our loss on factoring. In number 3 here, if all accounts are not collected, what amount should be recognized as our loss? The answer there would be your 413,150. That includes the recourse liability. Is it this time? Why is it this time the recourse liability is uh, included because again, uh, that's the initial amount of loss on factoring, and the loss on the recourse liability is not reversed because the accounts were not all collected. In number two, it's only 313, even though initially it was 413, but because we reversed the loss from the recourse liability of 100,000 since it did not materialize. The total amount will just be 313,150. Please take note of the differences of the problems, Kasa. Problem 8-19, first question is what amount was received from the financing? Second question is what should be reported as net realizable value? That's gross minus allowances. Number three, what amount should be recognized as doubtful accounts expense? Okay. During the second year of operation, share company found itself in financial difficulties. The entity decided to use the accounts receivable as a means of obtaining cash to continue operation. On July 1, 2022, the entity sold 1,500,000 on accounts receivable for cash proceeds of 1,400,000. No allowance for doubtful accounts was associated with these accounts. On December 15, the entity assigned the remainder of its accounts receivables 5 million of that date as collateral on a 2,500,000 12% annual interest rate loan from Finance Capital. The entity received 2,500,000 less a 2% finance charge. None of the assigned accounts had been collected by the end of the year. It is estimated that 10% of the accounts receivable would be uncollectible. Okay. What total amount was received from the financing of the accounts receivable? Okay, two transactions here, class. The first was on July 1. The entity sold 1,500,000 receivable for cash proceeds of 1,400,000. So you don't have to compute anymore. It tells us that we were able to get 1,400,000. Next, 2 million. We were able to receive 2,500,000 less a 2% finance charge. Okay, so we'll just multiply 2,500,000 by 98% since there's a charge of 2%. So 2,450,000 plus 1,400,000, we would get a total of 3,850,000, and that's the amount that we were able to get. Okay, second question, what amount should be reported as net realizable value? Okay. Next, we have accounts receivable that are neither factored nor assigned accounts that will form part of our gross receivables. We have 1 million. Then we have accounts receivable assigned of 5 million. We will include that. And then important theory here is: are you supposed to include the factored accounts receivable? The answer is no, because if it is already factored, that should not form part of your uh, receivables anymore. Okay, so our gross receivables would be 6 million. Okay. Now, are we just going to deduct the allowance of 100,000? No, because the 100,000 there is before adjustment. We will have to use the adjusted accounts receivable. Okay. And what does the problem tell us? It is estimated that 10% of accounts receivable would be uncollectible. How much is 10% of our receivables? 10% of 6 million will give us 600. Okay. So one way of getting this problem wrong, class, is if your total receivables would be wrong. If you included the factored receivable, then of course your allowance would also be wrong. Okay, so the receivable here would be 6 million times 10%. That would be our allowance for doubtful accounts. Question: is the 600,000 the amount of adjustment, or is it the adjusted amount of our ADA already? Since the method used here is a percent of our receivable, then the amount that we are getting is already the adjusted balance or the target balance of our ADA. So the 600,000 is not an adjustment to your 100,000. This is already the adjusted balance. So out of the 6 million gross receivable, deduct the adjusted balance of 600. The net realizable value at the end of the year would be 5,400,000. Last question, what amount should be recognized as doubtful accounts expense for 2022? The answer would be 500,000. Okay, why is it 500,000? Because our target ADA is 600,000 and we already had 100,000 before adjustment. So to bring our allowance for doubtful accounts from 100 to 600, we'll only have to recognize additional doubtful accounts expense of 500,000. So number 2, number 3 plus is actually test of your knowledge on estimation of doubtful accounts, not so much on receivable financing. Okay. Uh, we'll discuss discounting of notes receivable and we'll discuss notes payable further in another separate video class. Thank you.